Hello, CLA family, friends, colleagues, and community partners, and welcome back to our live stream. We're going to spend our time today talking about some key items, including an update on the legislation that was passed Friday, the PPP certification, and what we need to be doing on a weekly basis to track our loans for forgiveness purposes. In addition, the Fed has just issued an updated term sheet for the Main Street loan facilities, making 3 new options available. We'll discuss that in our session today. Starting with the Treasury FAQ issued on April 23rd, which focuses on the applicant's certification that the loan was necessary to support the ongoing operations of the applicant, as well as a safe harbor for borrowers. We've got Jack and Todd back today, along with Rick Kruger, who's a principal in our National Assurance Group, to walk through these key points. We're also going to pivot and do something a little bit different today, which is to open up the end of our session to you guys in the audience for your questions, to have our subject matter specialists tell you what you're really wanting to know right now. So please be thinking of these questions at the outset and send them on in through the chat. Leslie, Corey, Dan, and the team will be answering what they can and sending them to me to cover at the end of our session. Welcome back, Jack, Todd, and Rick.
Hi, Jen.
Thanks, Jen.
Hey, so Todd, we're going to start with you because the big breaking news today is the Fed releasing the updated term sheet for the Main Street lending program. Can you talk to us about that?
Sure, I can do that, Jen. Yeah, in fact, we were just looking for 2 term sheets, and instead what we got are 3 term sheets and an FAQ. So we got a lot of useful information today. I'll cover that at a high level for you, just kind of letting you know some of the things that came through on that. So overall, the Fed disclosed that they're going to be buying $600 billion of loan participations as part of these programs, right? Mm-hmm. And they did create that third program, but they're very similar, and there's a little nuance into that priority loan program that they added, but the terms are the new loan program, or the new loans, priority loans, and then expanded loans. So when I look at those, what changed? We talked before, they still have a 4-year term, right? Mm-hmm. But before, we talked about the minimum and maximum loan sizes and some of the effects of the comment letters, and we saw some of that come through. The minimum loan sizes were moved down to 500,000 from $1 million. That was helpful. And then we also looked at when you looked at the number of employees, that expanded. So it's up to 15,000 employees, up from 10, and some of the revenue margins expanded too. So you get a different band of range on eligible loan. When you looked at some of the certifications, lender or borrower wise, those didn't change all that much. But we did get some insight and change into the interest rate that would apply to these. So before, it was a SOFR rate that added 250 to 400 basis points. Now we're looking at a rate across the board that's based on LIBOR, a 1 or 3 month LIBOR, and adds 3% to that, 300 basis points. So the last question I'll cover is the last change is EBITDA. There were a lot of requests to change EBITDA, and they clarified that. They left it, they now refer to it as adjusted EBITDA, but when you look into that FAQ, they've expanded, they've said, what does that mean? That means how the lender would interpret borrower EBITDA at the date, basically looking back at the date in April instead of looking forward. So no changes to that really came through.
That's really helpful to know. And I think what you're saying about the Main Street lending program is going to help people, as you say, broaden that bandwidth of who can apply and what will be covered, which is wonderful. Now that we have that information, we want to pivot once again back to the 3P loans. And Jack, we want to talk about everything in the news lately about organizations returning those PPP loans or being subjected to SBA audits. What's causing all that activity?
Yeah, so there's a lot of new things that came out. A little bit came out right before our last live stream, where FAQ number 31 came out that talked about public or private equity companies and portfolio companies related to those, or larger public companies as well. And basically, what we perceive is that there's been some additional criteria that were added on to the certification that a borrower needed to make. The original certification in the application basically just said current economic activity or uncertainty makes the loan request necessary to support ongoing operations. Unfortunately, the FAQ went on now and added a little bit more to that. And it now says that borrowers must make this certification in good faith, which was always the thing, but taking into consideration the current business activities and their ability to access other sources of liquidity sufficient to support ongoing operations in a manner that is not significantly detrimental to the business. Now, Secretary Mnuchin came out on the 28th and said that, well, that was always in the spirit of what we anticipated, and that was always in the application. But that wording was never there before. And, quite often there was a lot of expectations that, look, what we were trying to do is keep people employed. And if we did that, and then we were adhering to the spirit. Now it seems like if you had other sources of liquidity, there's almost an expectation that a business was part of that social welfare net now. And that doesn't seem like the original intent of the program. So those things are very troubling, obviously. Now you throw on top of that, there was another FAQ that came out that not only said large public companies, but then they brought it down to just about everybody else. And it said in FAQ 37, they asked, is this appropriate for other privately held businesses as well? And then they just did the nice, oh, we'll refer back to number 31. So yes, it is. And so that was very nice of them. So we brought all that together, and now we're seeing a lot of concern about this. They've also introduced what's called the safe harbor, right? So you mentioned that May 27th or May 7th date, and that's a critical date. And there's a lot of misnomers out about what happens on that date. Todd's going to talk a little bit about some thresholds that are there for full audits going forward. And so we've gotten a lot of questions about, oh, well, if that 2 million is the threshold, can I just return a little bit to get under that 2 million so I don't have to worry about it? Unfortunately, it doesn't work that way. The loan is the loan, and that's going to be the set for the thresholds that Todd's going to talk about. However, if you want to be in the good graces of the SBA and feel like maybe you weren't able to make one of those representations given this new guidance, the only way to avoid potential issues is to return the entire loan balance, unfortunately. And we're starting to see banks now making sure all of their borrowers have really thought through this. So we're seeing a lot of correspondence going from banks to lender or to borrowers. And Todd's talked about this in the past with us. If you get the generic form letter, it's not necessarily saying we think you've done something wrong, return the money. However, if you get a letter from the bank that's fairly customized to your situation, they might be suggesting that based on a review of the application that they've probably gone back and done now, that potentially you may have some issues related to eligibility. So big topic. A lot of people are talking about it right now. We do feel it seems to be like a little bit of a retrade by Treasury here, maybe in response to the pressures that were out there in the press and that we're seeing from politicians. But nonetheless, it's now the new normal for us.
Well, and it sounds like everybody's looking for guidance and just really uncomfortable with the new normal. As you say, it's just, everybody wants to know. One of the things is, what should I do if I received a PPP loan? And if I'm still looking for or think I need one. So can you talk about that a little bit?
Yeah, we wish that there was case law out there on this, right? Unfortunately, the PPP program and then all of the fundamentals around it now are only a month old, right? And so we have no case law whatsoever on this yet. So, we were getting a lot of clients that are coming to us, asking us questions about what does my documentation need to show? If I have this, am I okay? As I mentioned on the last live stream, unfortunately, that's not an accounting question or not something, as an auditor, I can give you an opinion on that says, yeah, you're okay. If you have this, you've met your burden, right? And I will tell you, we've reached out to a number of attorneys right now, and this is a hot potato that even most attorneys aren't willing to give an opinion on yet. Now, eventually they're going to, and they're going to get into it, and they're going to have that. And it would be surprising to me at some point in time if there's not litigation that ultimately comes into play here because of the shifting landscape, right? But what we do know is that documentation is critical around this, right? And so you need to make sure you've got documentation as to your mindset on the date that you made the application. So obviously, if you had done that when you did the application, that would be the best source of information. However, the next best source would be to do it now rather than waiting until somebody asks you about it a couple months down the road. So we would definitely encourage you to do that. And now that we know that there's a number of these other factors that they're going to be looking for, you should incorporate that into your documentation, right? One of those new factors, what is the current activity as of your application date? So make sure you consider what's going on now, right? Not what could happen 6 months down the road if the economy stayed bad, but what is going on currently in the environment at that time, right? Cite the fact that other states were doing shelter-in-place orders. Maybe your industry was not deemed an essential business in other areas, or that it may be already closed down. Those are all very positive things in the current activity and environment that you're working on, right? Mm-hmm. The next part obviously has to deal with, do you have liquidity to support your ongoing operations? And so right away, people think, wow, if I've got a line of credit, that means I have to use my line of credit, so I was probably ineligible. I would argue that that's probably not what that meant, though, right? If your line of credit's there and it's there because you need it for your normal working capital needs, well, if you used it to pay your employees now and now you were tapped out, post-COVID, you wouldn't be able to operate in a normal fashion. And so you have to build all of those things and consider all of those when you're crafting your argument, right? Mm-hmm. And I would just encourage you, involve your legal counsel, though, because ultimately this is a legal sufficiency definition. It's not an accounting one. It's not a number box that you can say, if you got to this level, check it. And so you want to make sure that you're involving your legal counsel in these discussions.
Absolutely. And I hear that echoed in all the conversations. Make sure you come back to your attorney for advice on this. And as you said, you may get a pretty limited answer at this point just because there is no litigation to support any opinion. But definitely it's important to at least involve the appropriate advisors for this. So thank you for that commentary, Jack. I think it's helpful. Todd, I want to turn the discussion to you a little bit and just ask you, if the organization who receives the loan decides to keep it, what can it expect to have happen later?
Sure, Jen, I can do that because I think there's a little bit of confusion around that process because you hear different terminologies for the process. But I think from the lender perspective, that the process, at least at a high level, has been pretty clear. So let me share that with you because we do hear terms. We hear terms of audit or review or full review and things. And what does that mean? So let me just try to put some clarity on that. There's a process that when the borrower submits a request for forgiveness, there's a process of which the lender then has 60 days to look at that submission, maybe ask for some documentation, review and do some analysis of it, okay? Then there's a second step to that process, and that's where the lender turns around and puts together a packet of information and submits that to the SBA for their approval of forgiveness. That's another level of review. Now, we didn't quite know what level, and we don't have a lot of guidance as to what level is expected of review, is expected for lenders or what's going to be coming from the SBA. But the comments kind of shed a light on if you received a loan of $2 million or more, you will be subject to a full review. Well, the way I interpret that is that second review when the lender submits to the SBA, that just means that the SBA is going to take, and as they parcel that out and do different reviews of different levels, that's going to hit the pool. Let's get a more thorough review than maybe some of the smaller loans in the system. The smaller loans may get a cursory review or no review, but these are going to get a little more thorough review. So it's not something that's been introduced to the process. It's just letting them know that they're going to get that higher level of review in that SBA forgiveness process. And it's actually good to know that that's going to occur before forgiveness is granted, so it doesn't linger and hang out there after the process is already completed.
And I think that'll give a lot of peace of mind too, right? Just because everything does seem to change after the fact, knowing that this is going to happen before the forgiveness process might really give some people at least some peace of mind, right? That nothing's going to come back and bite them later.
Yeah,
Jen,
so I should add
one
quickly
thing.
though too, Jen, that's going to include like eligibility, forgiveness, and some of the use of the proceeds, right? So a little bit of detail on that. We don't have a lot of detail, but those are the things we expect that review to include at a minimum, okay?
Excellent. Yeah, thank you so much. And Rick, that makes it perfect for us to kind of turn the discussion to you. Now that we've discussed eligibility, what about the forgiveness and allowable use of funds? Can you share with us?
Yeah, absolutely. And I'm going to start to sound like a broken record here, repeating a lot of what Jack and Todd said too. The same general message applies when we're talking about allowable use of funds and forgiveness. And that really is document, document, document. At the end of the day, this is government funding and there are strings attached to it. They really want to ensure that PPP money is used for specific purposes, even if it's not forgiven. So it's absolutely important for organizations to track information in real time and accumulate that supporting documentation as you go. To do that, a lot of organizations have been using GL capabilities that they might have to track some of those details. Others have been using a segregated bank account to do some of that tracking and make sure that money they're drawing out of the bank account is allowable. But it essentially comes down to one thing, which is documentation as you go.
Well, and documentation being so important, can you dive a little bit deeper into the specifics of what you're talking about when you suggest that people document and support everything that they're doing?
Yeah, absolutely. Great question. So if we step back a moment, there's really two situations when documentation becomes important. The first is that we know, as Jack and Todd talked about, that the SBA intends to review all loans over 2 million and some of those below 2 million. So it's very possible that during those reviews, they're going to be digging into questions such as whether or not the borrower was eligible, if the funds were spent on allowable uses, and if that amount of forgiveness was correct. In addition to that, all borrowers seeking forgiveness are required to submit documentation along with their forgiveness application. The CARES Act does outline a few of the requirements for forgiveness, but it's important for borrowers to have all three of those in mind: eligibility, allowable uses, and forgiveness when they're building that packet of documentation. That's especially true because there are differences between allowable uses and forgiveness when you're thinking about the timing of when that money is spent and the types of costs that are allowed. To support the payroll costs, though, you want to make sure that you have your payroll reports and payroll tax filings ready to submit. For non-payroll costs, make sure you have invoices ready, canceled checks, bank statements. Additionally, make sure you've got all your key agreements set to go. That would include mortgages, debt agreements, leases, anything that you need to support that these documents were in place before February 15th, which is the key date in the CARES Act. Beyond that, there may be additional requirements. The SBA still has an option to add on more to that, especially as they begin to issue guidance on this part of the process.
And I think that really helps. One of the questions that just came in from the audience that I was reading as you were talking from Penny is, well, how can we document when there are so many questions to be answered? Can you comment on that?
Yeah, absolutely. And I'll start with the allowable uses and the forgiveness, and Jack and Todd may have something to add too when it comes to eligibility, because all three of these are really important things for us to document. But for allowable uses, track as you go. So make sure you know what is eligible in terms of cost, payroll costs and non-payroll costs, and track in detail. Whether that's a spreadsheet that you keep, and we at CLA certainly have some tools to help out with that, whether that's some general ledger capabilities or a separate bank account, make sure you're tracking invoice numbers, dates, all of that information, and assembling a packet of supporting documents to help out with that.
Yeah, I think that really helps, Rick. That's such a great answer to the question. And so now, as promised, we are just going to take this discussion for the next 10 minutes really to what the audience has to ask based on the things that you guys have been sharing. So if you don't mind, I'm just going to dive in and share and read some of these questions. One of them, Rick, this is probably a better one for you, or maybe Jack, which is, can we get a legal or accounting opinion on whether we are okay or not with PPP? And Jack, I think you touched on it.
Let me take a first pass at that. So I do think that, that will be a level of a service that that people will offer, right? So you can go to your attorney and your attorney can definitely do that. From an accounting perspective, there is a level of service that we could do to support that. It would probably be something that, as CLA, we would do for an organization that we didn't help secure the loan. And if you were helped by CLA, you would want to use a different accounting firm to do that, because it would be seen as self-serving for us to give an opinion that your documentation was sufficient when we assisted you with obtaining the loan to begin with, right? So if you do that, you want to make sure that it's done under the discussion with an attorney, right? And so the attorney would actually work to engage somebody on your behalf to determine the sufficiency of the documentation. And then collectively, what the opinion you could get from the accounting firm and the law firm together would bolster your claims as a corporate entity. But I mean, ultimately, the corporate entity and the signer of the application are the ones that provided the certification. These would just be things that you could, place a degree of or get a degree of comfort with down the road.
Excellent. Thanks so much. One of the next questions that came in from Nathan was about costs that can be included in forgiveness. One of them was, can fuel costs be included in PPP forgiveness? Can you guys comment to that?
I wish I could comment in a meaningful way, but there's a lot of questions when it comes to forgiveness that we just don't know all the details for. Utility costs, certain utility costs are allowable for forgiveness and are an allowable use under PPP. There is some allusion to certain fuel costs in some of the ancillary guidance out there, but really nothing that clearly says yes or no, these are or are not allowed at this point. For the most part, when it comes to the details of forgiveness, we're still waiting yet on details from the Treasury.
Okay. Another question that we had, and I saw it also on Tuesday's live stream, so I think it's probably important to highlight, is people are asking if they can bonus out their employees to bolster their payroll expense. Can one of you guys speak to that, please?
Yeah, happy to start out here. So again, still waiting on some of the details, but while we do wait, the framework that I like to think of when it comes to costs from a forgiveness perspective, we do have a little bit of information from the letter of the law itself, the CARES Act, and we do also know a little bit of information about the spirit of the law and what's intended to do. So in terms of the letter of the law, when it comes to compensation or really anything, it says costs need to be both incurred and paid during the 8-week period beginning at loan origination. They do use the term "and" there, which makes us think that they both need to be incurred, so that would have had to have been incurred during that 8 weeks and paid then. The spirit of the law is to keep workers employed, retain workers, and maintain their wages. So again, it would seem that some of that would meet both the spirit and the letter of the law if structured appropriately. But certainly we all wish we had a little bit stronger guidance to hang our hat on.
Yeah, I would just add to that two things. One, clearly, if you hadn't paid, let's say, 2019 performance bonuses yet because you saw this on the horizon, clearly paying those with those proceeds likely would not qualify because of that incurred and paid piece. The only other thing that you need to consider is we do have a $100,000 annualized limitation per pay period, right? So you could not give everybody $10,000 bonuses in one pay period, because on an annualized basis, even if that was monthly, now you're at 120,000. So a portion of that would be disallowed. So you do have to take into consideration base wages plus the bonus. And if any of that goes above that $100,000 limitation on an annualized basis, it would be disallowed. So I think you can use them, but you have to use them wisely and to make sure you don't run afoul of any of the limitation rules that are out there.
That makes sense. Well, while we're talking about wages, I want to throw out this quick question from Alexis, which is, are salary costs for employees hired after February 15th going to be eligible?
They generally should be. That the test for forgiveness is really just, did you pay workers during that 8-week period? That would be the starting point. And there are adjustments up or down depending on FTE count and wage reductions that may have occurred. But the very basics would include any employee up to, like Jack said, the 8-week equivalent of 100,000 annually, which is about 15,000, a little bit more than 15,000.
Excellent.
Yeah, the only test that's out there that's really done on an employee by employee basis is if you had an employee that was employed with you before and they were also there during the 8-week period. And as a result of that, you have to make sure that you're paying them a comparable wage, right? You can't decrease their wages by more than 25%. There are questions about how that test gets applied, though. So if it is a new employee and they didn't have a prior quarter, you would assume you would be okay, and 100% of those wages would be allowable, again, up to that $100,000 maximum. But there is a concern. What if you don't hire somebody back, but you replace them with a new FTE? Does that person that wasn't come back, does that count against you 100% of their comp? We hope that we get guidance out on that. The FTE test doesn't talk about an individual employee. It talks about FTEs as essentially fungible, numbers. And so hopefully, the new employees will be includable, and any old employees that you're not able to bring back won't penalize you as long as you replace them with new workers.
Great, thanks so much. I want to pivot to a topic that seems to be coming in on cash reserves, just a ton of it. So Jack, maybe we could start with you with this question from Greg that says, does a private company need to use cash reserves before they can certify that a PPP loan was necessary?
If we could answer that question with certainty, we'd have the goose that laid the golden egg, right? Unfortunately, we can't, but I'll go back to my comment earlier where I used the example of a line of credit, right? Cash is the same thing, right? Every business maintains a normal level of working capital. You need that to pay your bills, allow you some float when your receivables get stretched out. You have to have normal working capital in order to run your business, right? So if they wanted you to use amounts that were going to eat into that normal working capital to pay payroll, and that would cause you not to qualify, that would seem to be against the spirit of, detrimental to ongoing operations of the business, right? So again, I can't give you a direct answer that says, yes, it's okay. But with that being said, I think you build an argument around what normal working capital or normal reserves would be. And then that is a reason why you wouldn't be able to deploy those to keep your employees employed during that period.
That makes a lot of sense. The next question, I'm just going to knock out probably 2 more questions before we close our session. So forgive me for moving quickly through these, but there's one from Ingrid just asking, can I get clarification that the PPP cannot be held and used for future uncertainty?
Again, I wish we could say that, because, particularly with the more recent guidance, it does specifically talk about you have to figure out your current situation, your current activities. The other piece, and everybody is focused on kind of the second certification that's there. The third certification right below that says that you're going to use the funds to retain your workforce, pay them a comparable wage, pay all those other allowable costs as outlined in the PPP program. And when you look at the program, they talk about you're going to do that in the period from February 15th through June 30th, right? So if you kind of take that certification and the one right before it and you put them together, it would seem that like you would say, I need this loan because I want to keep people employed between now and June 30th. Now, I will say that if down the road, let's say you're a nonprofit and your main fundraiser, which is in July, is going to be impacted, you might make decisions today to conserve cash. That might be a reason, and that's not necessarily a future economic uncertainty because that fundraiser is going to be impacted. So there are things that could happen outside the period that would impact you during the period that can be considered. But I don't think you can say, well, business is great now, but I think I might have a lull in Q4. That might be why I need to do this. That probably wouldn't be that good reason.
Excellent. I think that's helpful. Do either Todd or Rick, do you have any comments on that?
No, I would agree. I would
Okay.
agree with what Jack said from a lender perspective of looking at that. I think you take about the same perspective.
Excellent. So I have to say, we've got a couple other questions about pay and PTO and some other things. I'd like to just suggest that, you know, the audience just wait for us really fast to get back to them. We keep a digest of the chat and we'll do our best to just respond. Please also continue to look for more guidance from us on claconnect.com on our COVID landing page. Also, feel free to contact us using the buttons there. We will connect you to the right person to answer your questions. On future live streams, we'll continue to talk about this and other highly relevant topics to the business right now, including Leslie will be back on Tuesday with the important topic of insurance coverage right now that is really as big of the loans playing a part in what everybody's doing. So please come back and join us for that on Tuesday. I want to thank our presenters today. I want to thank our audience for the incredible questions and our moderators in the chat for really feeding us the things that people need to know. So we look forward to seeing you again on future live streams. Thanks so much, everybody, and have a great and healthy day.
Thanks, Jen.
Thank you.
Thanks.